So where do we go from here? Well, even after the monster run last month, Broden thinks we've got still more upside. Check out this new version of the S&P 500 daily chart. The FIP Queen's shooting for still higher upside targets based on her usual methodology. The first one is at 3,015, up less than 2% from here. That shouldn't be a difficult hurdle to jump. Her next target comes in at the 3,093 level. That's to the 3,102 level. That's up a little more than 4%. And if we can break out over that level, the S&P, she says, could go to 3,308. Which would represent a fantastic 11.3% gain. What a year that would be. That sounds darn good. However, Broden also notes that we're flashing right now a cluster of Fibonacci time cycles that fall between yesterday and the 4th of July. And like I just told you, when an index hits a bunch of these timing cycles, well, guess what? It means we're in for a reversal. So while Broden likes where we're headed long-term, obviously, I mean, this would be incredible, right? Right now, the chart's telling you to anticipate a little, let's say, pullback, maybe later this week, tomorrow, Friday. That said, she'd be a buyer into weakness, good opportunity. You just need to learn from the recent past year. She'd only be a buyer so long as her sell trigger doesn't fire, meaning as long as the S&P's 5-day exponential moving average holds above the 13-day. If we get a bearish crossover in these two, she'll become more cautious until we get another set of clear Fibonacci signals that predict a bullish reversal. Ultimately, Broden thinks we'll see much higher prices from the December lows, and that is quite the contrary to all these bears that I keep hearing on TV, or like faux bulls, I guess is a better word for saying. But we might experience some turbulence along the way, and she warns that the turbulence might be coming very soon. All right. If you understand what's driving the S&P 500, why don't we consider one of its largest components? Something I talk about constantly. Yep, you guessed it, Apple. Every time investors wrote off Apple's prospects, what did it do? The stock came roaring back, which is how the stock is now back a couple of bucks over 200. You know why I'm a believer in Apple. Even though the company is caught in the crossfire of the trade war, one of the few large operators that had the potential to be shelled by both sides. The company is transforming itself into the world's best consumer goods play with a fabulous razor blade business model where they sell you the phone or the watch so they can make money charging you for various subscription services for years and years. I sure wish they'd start explaining the story just like I said in terms of the lifetime value or LTV of their subscribers, because that's what's going to matter, not the handset sales. That is the conclusion of a much thought that I had, just like I kind of dreamed up the whole service revenue thing. But what about the technical side? Take a look at Apple's daily chart. As much as it's already run, Broden says that if this stock can clear its current hurdle resistance at 205, and we are right there, she sees a lot more upside. In fact, her methodology suggests that Apple could run to $227 and maybe even $243. People are talking about all-time highs here. Once again, though, if the 5-day exponential moving average crosses below the 13-day, all bets are off. And I know you hate that like buy high, sell low thing, but she's been right. So let me give you the bottom line. The charts, as interpreted by someone who's been very right for our show, Carolyn Broden, suggest that both Apple and the broader S&P 500 have more room to run, maybe much more, but that the next few sessions might get a little dicey. So long as we don't get a bearish 513 crossover, she thinks you could safely buy into any weakness.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.